my name is Elliot Gu. I'm the founder and editor of the Creating Wealth service. Now, I've created this video today for two main reasons. First, I've heard from several readers asking if markets might rally this year because the Fed pivots on interest rates. After all, current market expectations are for the Fed to raise just one more time by only 25 basis points in May, followed by 75 to 100 basis points, a full percent, of cuts by early next year, by January 2024. So I want to address that Fed pivot and sort of mild recession bullish narrative that's making the rounds right now. Secondly, I want to tell you a bit more about a recent recommendation I made in the Creating Wealth model portfolio. Now, it's a relatively new exchange-traded fund, ETF, first listed for trading just last summer, in the summer of 2022, with a pretty unique and I believe widely overlooked strategy. Now, I believe it's a strategy that can actually reduce your downside risks in the current market environment while profiting directly from volatility, the degree of movement in financial markets over the next few years. And by doing so, it actually enhances your income and distribution potential in this ETF. In fact, this ETF's most recent distribution, monthly distribution, annualizes out to a more than 22% yield. So I'll tell you a little bit more about that here in just a moment. But first of all, let me back up and address that Fed pivot bull idea or theory. Simply put, if the Fed does cut interest rates by 75 to 100 basis points this year, it's almost certain to be the result of a looming US recession or recession already underway. Indeed, the specific indicators I follow in the Creating Wealth service, including my bear market checklist, that track economic conditions, they're all pointing to a high risk of a US recession. I'd estimate around a 90% or a little more probability this year, 2023. Now, here's the key point. If this recession call is correct, the US market has further to fall, and the lows from last October are unlikely to hold. So take a look at this table. Now, this chart shows every notable recessionary bear market, that's a bear market in the S&P 500 in the context of recession, since the 1870s, so about 150 years. And it includes the date the recession started, that's the leftmost column, the month the market bottomed, and the month the recession ended. So that's the month where the S&P 500 hit its lowest monthly close. Now, as you can see, the typical pattern is that the market peaks before the recession, then sells off and bottoms before the recession ends. Now, out of the 16 listed market and economic cycles on this table, there is only one occasion where the stock market formed a major low before the economy even entered recession. So typically you have the market peaks, start of recession, market low, end of recession. There's only one occasion in this history, the 16 cycles, where the market actually found a low before the US actually entered recession. And that exception is this December 1917 bear market low, which was associated with the 1918 to 1919 recession. So the market bottomed in late 1917, and then the US economy didn't enter recession until 1918. But this cycle was unique because of World War I, which started in the summer of 1914 and ended with an armistice on November 11th, 1918. Now, the United States officially entered the war on October 6, 1917. So the economic cycle was driven by military spending in 1917-1918, followed by a hangover as spending declined, US military demobilization in late 1918 and through 1919. So it was a very unusual cycle. I'm a big believer in the old market saw that holds the most expensive words in financial markets are, this time it's different. So unless this cycle is different than 15 of the last 16 market and economic cycles over the past 150 years, the October 2022 lows for the S&P 500 around 3,500 won't hold if the US enters recession later this year, as I expect. Indeed, I continue to target a sell-off to around 3,000 to 3,100 at some point this year in the S&P 500, which represents a more than 1,000 point decline in the index from current levels. So how does one invest when the economy is likely to enter recession, probably in just a few months? Well, one of the things I've been recommending in creating wealth lately is to increase exposure to treasury bonds. So that's US government bonds, which have actually performed quite well this year, beating the S&P 500 in some cases. Now, there are two reasons why I think this is time to increase your exposure to the bond market, the government bond market in particular. First, when the economy falls into recession, inflation is likely to cool, at least temporarily. I don't think it's going to cool for good, if you will. And the Fed is likely to pivot in favor of addressing economic growth by cutting interest rates rather than continuing to hike rates to cool inflation. They're going to pivot from their inflation-fighting mantra to their growth-supporting mantra, if you will. That's likely to have the effect of driving down long-term treasury yields, which means higher bond prices. Second, treasuries are a classic risk-off asset. They tend to rise in value when the stock market falls in value as investors seek a haven for their funds, a safe haven. And since treasuries generate a yield, that income stream helps compensate investors in treasury bonds while they wait for economic conditions to improve and the stock market to stabilize. So you earn a yield while you wait for the cycle to play out. Now, you can benefit from this by purchasing an exchange-traded fund, or ETF, that tracks U.S. Treasury bonds. An example would be the iShares 7 to 10-year Treasury bond ETF, which trades under the symbol IEF, and that is actually an ETF I do currently recommend in my Creating Wealth model portfolio. Now, there's another ETF that tracks longer-term bonds, the 20-plus year Treasury bond ETF that trades under the symbol TLT. However, I do have some words of warning. While I expect treasuries to outperform the S&P 500 through most of 2023, I do not think it's going to be a smooth ride. In fact, I believe volatility in the government bond market and ETFs like IEF and TLT that I just mentioned will remain elevated over the next several years compared to what we've become accustomed to since the financial crisis years of 2007 to 2009. Now take a look at this chart. Now this chart shows the implied volatility priced into call options on that long-term US government bond, treasury bond ETF, TLT, which is an ETF I just mentioned. Now the higher the implied volatility, the more expensive, the more the market expects the bond market to move around, the more variability you'll see in bond prices, the more sort of jagged volatility you'll see. But there's an upside to that, which is that it makes options, these are call and put options on that ETF, more expensive. Now this shows the weekly implied volatility since the end of June 2009. Now I've labeled some spikes in bond volatility over this long period, including the COVID lockdown panic in 2020, the taper tantrum, you might remember that back in 2013, which is when the Bernanke Fed announced plans to wind down quantitative easing. And then you have the US sovereign credit downgrade back here in August 2011, you probably remember that, where US sovereign debt was downgraded from AAA. All of these events did cause short-lived spikes in volatility and implied volatility in bond market that faded within a few weeks. But generally, as you can see here, that bond market volatility remained kind of in the 10 to 15% annualized range on this basis for most of the period covered by my chart, with a few exceptions. Now, this is actually a feature of the Fed's accommodative monetary policy over this period. In short, coming out of the financial crisis and Great Recession years of 07 to 09, the Fed was primarily focused on supporting growth rather than fighting inflation. Indeed, for most of this period, inflation was well below the Fed's 2% annual target. Now, of course, keeping interest rates near zero was part of that plan, as was quantitative easing, buying bonds to depress yields of all maturities. However, an equally important component of the Fed's strategy was what's known as forward guidance on rates. Essentially, the Fed sought to reassure markets that it would maintain ultra-low rates, ultra-accommodative monetary policy for as long as the economy and markets needed support for growth. This also reassured companies, individual companies, that their borrowing costs would remain low. Even when the central bank did hike, as they did in 2015 and 2018, they did so at a glacial pace, certainly compared to any real prior economic cycle. Now, the result was low yields, but it was also a collapse in bond market volatility, which is what you can see on this chart. However, as you can see, right, that's all changed since roughly the middle of 2021. And applied volatility in this TLT ETF I'm showing you here has risen from that 10 to 15% range all the way up to an 18 to sort of 25% range in recent months. And unlike prior occasions where it kind of spiked and came right back down, it's remained elevated consistently for most of this period. Now, this is also by design, right? And it's part of the Fed's tightening plan. It's part of the Fed's inflation fighting plan. You see, the Fed is now fighting inflation, not trying to support growth. Thus, they're raising interest rates, and through a series of supersized 75 basis point hikes last year, the Fed has been tightening at the fastest pace in 4 decades. The Fed does not want the market to believe it's likely to cut rates aggressively at the first sign of trouble. Indeed, Chairman Jerome Powell and other speakers have attempted to stress their plan to tighten policy, keep financial conditions tight in the U.S. economy until inflation is clearly back under control. Now, the near-term, intermediate-term, and long-term path and level of interest rates is more uncertain today than it has been in almost any time in the past 30 years, and particularly since the forward guidance era that started back in that 2007 to 2009 market episode. Now, my view is that this will continue for as long as the U.S. and most economies around the world remain in a more inflationary, even stagflationary regime. This will force central banks to balance their mandates of supporting growth and controlling inflation in a way they just haven't done in close to 30 years. Simply put, I'm bullish on treasuries and believe yields will generally fall over the next 6 to 12 months because I am looking for the U.S. economy to enter recession. This will likely prompt the Fed to eventually at least cut rates, and it should also drive a significant leg lower in the stock market. Historically, investors flee to treasuries as a safe haven against a falling stock market, as I mentioned earlier. However, it's unlikely to be a placid rally in bonds or decline in yields. I'm looking for more of that jagged volatility like what we saw back in the 70s, and such as we've seen last summer. An inflated implied volatility in the fixed income options market goes along with that. Now, the ETF I recently recommended in my Creating Wealth service uses this inflated volatility in bonds to its advantage to generate additional income for investors using options. Now, this specific strategy, known as a covered call, tends to reduce risks amid the, I think, inevitable short-term pullbacks and corrections we will see in treasuries this year. As I said, I expect a lot more volatility. And simultaneously, it actually profits from rising volatility in bonds that inflate the premiums in the call options market. Keep in mind, the buyer of this ETF, the ETF I recommend in the service, does not need to trade options. It's actually just part of the ETF strategy. It's all sort of behind the scenes for you as a buyer of this ETF. Look, the ins and outs of exactly what this ETF does, its exact strategy, are a bit too complex to explain in this short video. However, I just wrote up a detailed piece explaining how it all works in my premium Creating Wealth service. And I like to give you access to that today with absolutely no risk or obligation. In particular, you can get all the specifics of this ETF and all of the recommendations I make in Creating Wealth right now with a risk-free trial subscription to the service that's available by clicking the link adjacent to this video. Now, as I said, there's no risk or obligation associated with your trial subscription to Creating Wealth. Simply click the button, take us up on our risk-free trial offer. If you don't like it for any reason, cancel your subscription for a full refund. No questions asked. Now, thanks again for listening. I hope to greet many of you. I hope you found this video useful, and I hope to greet many of you as new readers of the Creating Wealth service here in just the next few minutes. Thanks again.